Hello and welcome again to Logistics Blog. This is going to be another quick video on Incoterms. We're looking at CIP and CPT today. So CIP stands for Carriage and Insurance Paid To, and CPT is just Carriage Paid To, so the same but without insurance. And it's paid to the named place, which is nominated, a nominated point which is nominated by the buyer. So they'll nominate where they deliver or receive the goods for their consolidation, and these terms are generally used within a continent where there's no long sea journeys involved. So if we just have a quick look straight into this, so for the seller then, the pros and the cons. So to start off with, we have a controlled dispatch of the goods. As they are organising the transportation of the goods, they'll know the haulier or when the haulier will be coming into their warehouse to collect the goods. They'll have larger volumes of goods, and again, working with my next point, allowing consolidation with other exports can help reduce the price. Obviously getting cheaper prices off hauliers that they use regularly. The next point will be the packaging, so they can pack to their own specifications, so they don't have to order in any particular packaging unless it's specified by the buyer, obviously. It can speed up payments as well. Rather than relying on the buyer's nominated haulier, the control lies with the seller for the speed of the delivery, so the payment terms will generally start from the date of the delivery or upon production of the proof of delivery. And the last point for the pros is the freight cost can be used to adjust the price of the product. So obviously, if they want to make more profit, they'll increase the cost of the freight. And for the cons, let's have a look at that. So they have obviously a larger financial outlay, which will be even greater if it's CIP as well, because they'll have to fork out for the insurance. And what else is there? Let's have a look at the next one. So increased documentary obligation. They'll have more export documentations to complete, and possibly import documentation. The fluctuations in the currencies can affect their margins. Obviously, it's a fixed price for the product and the delivery. Change in a bad way, then obviously they'll lose money, but then again, on the other hand, they could end up being more profitable for them. They have to prepare the export documentation, which I said earlier. Don't know why that's there again. Difficulty in pricing products, again with the currency fluctuations and the cost of the freight. If the cost of fuel increases unexpectedly, then they'll have to sort of suck this into their price, and if they have a long production time, they might not be able to put this into the price of the products, so they might have to take it out of their profits. And the production delays can be costly, as they could have penalty clauses that come into operation due to contractual obligations. So that's for the seller. Now for the buyer's point of view, so here, so the pros and the cons again. So structured pricing, obviously they've got one price and up to their nominated point of delivery or warehouse, so they know how much it's going to cost them. They've got a limited outlay of the cash flow, as the seller will be forking out for the transportation. Slightly reduced documentary obligation, as the seller will be doing all the export documentation for them. And obviously with CIP, the insurance will be covered, so they'll have peace of mind. For the cons, so the packaging again might not be suitable for their warehouse setup. Credit terms, it might be slightly random, as the it'll start from the date of receipt, unless there's any penalty clauses in place, but this is dependent on the seller's haulier when the goods will actually arrive. And supplier reliability, So they're reliable upon the seller's production reliability and the haulier and their efficiency at delivering the goods, obviously. So that could affect their reliability. And the last con that we have for the buyer is it reduces the chance of consolidating the supply chain. So if they did it themselves, they may be able to consolidate the supply chain and make the goods slightly cheaper. So that is it for CIP and CPT Incoterms. I hope you found that useful. Let us know what you think. Leave a comment below for us, and we'll get another video up soon.